This is a summary of the book Super Trader by Van K. Tharp. Tired of losing money in the stock market, even when times seem good? Super Trader by Van K. Tharp shows you how to make steady profits in both up and down markets by first fixing your own mindset and habits. Discover simple ways to build a strong plan, handle risks wisely, and avoid common mistakes that hurt most people. This book turns trading into an easy-to-follow path for real success, helping you grow your money safely no matter what happens. Let's begin. Let's find out more.
It's great to be diving into this one. We look at a lot of books on trading and investing, and most of them, they start with a chart or maybe an economic theory.
Yeah, they jump right into the weeds of moving averages or PE ratios.
Exactly. This one, though, it starts by holding up a mirror. And for a lot of people, I think what they see is probably not going to be very comfortable.
A mirror is the perfect way to put it. There's this common idea that to win in the market, you need a secret edge. Some piece of information nobody else has.
Right, that you have to outsmart Wall Street.
But Van Tharp's whole argument is that the only person you really truly need to outsmart is yourself.
And he wastes no time proving that point.
Yeah.
He opens with this cautionary tale of a guy he calls Joe Smith. Now, Joe's not a real person, but he might as well be. He's this archetype for the average person who gets chewed up by the market.
And the really painful part is that Joe isn't some fool. He's actually a smart guy.
Oh, he's brilliant in his field.
Yeah.
Tharp describes him as a retired civil engineer. Now, just think about what that takes for a second.
Years of study, discipline, math, physics. You can't fake being an engineer.
You absolutely can't. If you build a bridge wrong, it collapses. It's life and death. So Joe is smart. He's diligent. He's saved up a decent nest egg, something like $600,000. He's done everything right in his life.
But he falls into that classic trap, doesn't he? He assumes his intelligence in one complex field will just translate over to another.
Perfectly said. He treats investing like a hobby anyone can do.
Yeah.
So what happens? The year is 2000, the dot-com bubble bursts, and bam, he loses about 30% of his money. It hurts, but he rationalizes it. Market volatility, it'll come back. And he starts doing what everyone does. He watches the financial news.
Yeah.
He listens to the TV gurus.
Jim Cramers and Suze Ormans of the world.
The very same. And he claws some of it back over the next few years. He feels like he's starting to get the hang of it. He feels vindicated.
And then 2008 comes knocking.
And 2008 just obliterates him. Because he's following all this standard advice. Buy and hold for the long term. Don't try to time the market. It's not a real loss until you sell.
All the things that sound wise until they're not.
And because he has absolutely no plan for a catastrophic event, he just rides it all the way down. He loses almost 60% of his equity from the peak. He's just devastated.
So here's the question, though. How is that different from just being incredibly unlucky? Everyone got hit in 2008.
Well, Tharp makes this killer point. He says, Joe spent 8 years of his life learning how to be an engineer. 8 years. He understands that you can't just walk onto a construction site and build a bridge. But he treats his entire life savings, the foundation of his retirement, like something he can figure out on the weekend.
The stakes are just as high, but the preparation is zero.
It's the barrier to entry, right?
Yeah.
To be a doctor, you need a decade of school. To be a trader, all you need is a brokerage account and a few $100. And that low barrier tricks us into thinking it's easy.
Which is really the core idea of the whole book. He's saying the questions people ask are all wrong. They ask, what stock should I buy? Instead
of what's wrong with me that I keep losing money, it's a fundamental shift from looking for external answers to doing internal work.
So let's get into that internal work, because he has this formula that he actually updated over time, which I found really interesting. He breaks trading down into 3 components.
He does. And originally, years ago, he taught that trading success was a mix. He said it was 60% psychology.
Which is already a huge number for most people.
Already, yeah. Then 30% position sizing, which is basically how you manage your money, how much you risk. And then only 10% for the system, your actual rules for when to buy and sell.
Even that is radical. Most beginners think the system, the magic indicator, is 99% of the game.
But here's the kicker. In Super Trader, he says, you know what? I was wrong. He revises it. He now argues that trading is 100% psychology.
Okay, wait a second. 100%. How can that be? I mean, the math has to matter. The system has to matter.
It sounds like an exaggeration, but his logic is actually pretty solid. Think about it. Who designs the system?
You do.
Who has to find the discipline to actually follow the rules of that system, especially when the market is going crazy and you're terrified?
I do.
And who decides how much money to risk on any given trade? The position sizing. It's all you. So the math and the rules might exist on paper, but they are completely useless if the person executing them is driven by fear, greed, or ego.
So the human element is the only one that can actually fail. The system can't fail on its own.
Precisely. Your psychology is the operating system. If the OS is full of bugs, it doesn't matter how good the software applications are, they're just going to crash.
Which leads right into what he calls the single most critical trait of a trader. And it's not what I expected. It's personal responsibility.
This is the first big wall most people hit, and most of them don't get over it. He has a simple test. When you have a losing trade, what is your first gut reaction?
I mean, if I'm being honest, it's easy to say, well, the market did something unexpected, or the Fed announcement screwed up my trade.
Exactly. You blame something external. The market, the broker, bad luck. Tharp is brutal on this point. He says if you blame anything outside of yourself, you have adopted the mindset of a victim.
And victims can't learn.
Victims can't learn because it wasn't their fault. If the market did it to you, then you're powerless. It could just do it to you again tomorrow. But if you say, I created this result, I chose to enter here, I chose to risk this much, I made a mistake, then what?
Then you have the power to fix it. You can analyze your mistake and not make it again.
Now you're in the driver's seat. It's a heavy burden, like you said, but it's also incredibly empowering. It's the only way to grow.
It really separates the people who are just interested in trading from those who are truly committed. I love his brain surgeon analogy for this.
It's so good.
Yeah.
You can't just wander into a hospital and say, hey, I've been watching some videos on YouTube. I'm kind of interested in brain surgery. Can I give it a shot?
Laughing. They'd have security escort you out, I hope.
Right. It's absurd. It requires a decade of insane commitment. But because you can open a trading account in 10 minutes, people think interest is enough. Tharp says no. You have to be willing to do whatever it takes. That means working on your own psychological junk, building a detailed plan, studying every single day.
And a huge part of that psychological work is digging into your beliefs. He has this line that just stopped me in my tracks. You do not trade the markets, you trade your beliefs about the market.
This is so profound. We think we see the world as it is, but we don't. We see it through a filter of our own beliefs. He tells this really personal story about his niece to drive this home.
Yeah, Nandini.
Right. So she comes to live with him, and by any objective measure, she's amazing. She's a biomedical engineer, she's a gifted artist, and he describes her as just, incredibly beautiful.
She has it all, basically.
Objectively, yes. But her internal reality was completely different. One day she says to him, Uncle, in my next lifetime, I would like to be born beautiful and talented.
Wow, so she couldn't even see what was right there in front of her.
Her core belief was, I am not good enough.
Yeah.
And that belief acted like a filter that blocked out all the evidence to the contrary. Her reality was the belief, not the truth.
And that applies directly to the market. If my belief is the market is rigged against the little guy,
then your brain will actively search for evidence to prove that right. You'll ignore all your winning trades, and you'll fixate on the one time you got a bad fill from your broker and say, see, I knew it. You'll probably lose money just to satisfy your belief.
it's so perverse. We would rather be right about our negative worldview than actually be successful.
We would rather be right than rich. It's a human flaw. So he suggests an exercise, and I think everyone listening should actually do this. Sit down and write out your beliefs about money and the market.
Things like, you have to take big risks to make big money, or I'm just not good with numbers.
Exactly. And then you don't judge them on whether they're true or false. You judge them on whether they are useful. You ask a simple question. Does this belief serve my trading goals?
So a useless belief would be, I have to be able to predict what the market will do next.
Totally useless, because it's impossible. It just creates anxiety. But a useful belief would be, I don't need to predict the market. I only need to follow my rules. See the difference? One is about control over the uncontrollable. The other is about control over the only thing you can control, yourself.
It's about building a psychological framework that supports success, not one that sabotages it.
And part of that is understanding your own wiring. This gets into his Tharp trader test and the different personality types.
Yeah, he has 15 of them. And he's not saying some people can't trade. He's saying, you need to build a system that fits your personality, not fight against it.
Right. It's about knowing your strengths and, more importantly, your fatal flaws. For example, he talks about the fun-loving trader.
Who's the worst fit for trading? which is kind of funny.
It is. He uses Howard Schultz of Starbucks as an example.
Yeah.
Obviously a genius businessman. But Tharp speculates he'd be a terrible trader. Why? Because good trading is often really, really boring.
It's methodical, it's repetitive, it's not a party.
And a fun-loving type needs stimulation. They need action. So if they get bored watching a chart that's not doing anything, what are they going to do? They're going to make a stupid trade just to feel something. They create their own destruction out of boredom.
Whereas you have the strategic trader type, like he mentions Paul Tudor Jones, they're great at seeing the big picture, but their weakness is perfectionism.
Exactly. They might have the perfect trade idea, but they'll analyze it to death, waiting for the absolute perfect entry point, and they miss the move entirely.
So the key is to know yourself. Know your type so you can build guardrails against your own worst impulses.
And he gives you tools for that. He calls them vitamins for your soul, which I like. Things like mindfulness and dissociation.
Let's break those down. Mindfulness is a word we hear a lot, but what does it mean for a trader?
In this context, it means being able to look at the market and see what is actually there, without all the stories and emotions you're layering on top of it.
So not, oh my God, the world is ending, the stock is crashing, but
the price has moved below its 50-day moving average. It's just data. The mindful trader in 2008 saw the charts pointing down and got out, while the emotional trader was listening to the news saying, the Fed will save us, and held on. Mindfulness is seeing what is, not what you hope for.
Okay, and what about dissociation? That sounds a little intense.
It's a powerful mental technique. Top traders like Tom Basso, who they call Mr. Serenity, use this. He describes it as imagining you're floating out of your own body and watching yourself trade from the corner of the room.
Like you're a third-party observer.
Precisely. That observer in the corner has no emotional attachment to the money. The observer isn't feeling fear or greed. The observer's only job is to ask, is the person in that chair following the plan? It's a way to short-circuit that fight-or-flight emotional response.
And to retrain that voice in your head, the inner interpreter he talks about.
Oh, yeah, that voice is constantly telling you you're an idiot, that was a stupid move.
We'll have it.
Tharp says you have to retrain it to be a constructive coach, not an abusive critic.
So instead of beating yourself up after a loss,
the voice should say, okay, that was a tuition payment to the market university. What lesson did we just purchase with that money? It reframes failure into education.
That's a huge shift. And that ties into another one of his more out there concepts, which is removing stored charge. What does he mean by that?
It's basically emotional baggage. Let's say you have deep-seated anger issues or you feel guilty about having money. Tharp's point is that this stuff doesn't just stay in your personal life. When you're under the immense stress of trading, that charge is going to come out sideways.
So if I have issues with authority, I might find myself fighting the market trend just to prove I'm right.
You're not fighting the Dow Joneses, you're fighting your dad. And you're going to lose.
Yeah.
He argues that doing the personal work to clear out that old emotional junk is actually a core part of a trading strategy. You need to be able to act from a place of neutrality.
Okay, so this is a ton of psychological heavy lifting. This is part 1 of the book, and we haven't even placed a trade yet.
And that's the point. You have to build the foundation before you can build the house. The foundation is you.
So let's say we've done that. We've looked in the mirror, we're taking responsibility, we know our type. Now we move to part 2, developing a business plan.
This is where it gets concrete. And his central message here is non-negotiable. Trading is a business. It is not a hobby. It is not a casino trip. It is a business.
And what's the first thing any real business needs?
A written plan. He says most traders have no plan at all. And that would be insane in any other field. You wouldn't try to build a skyscraper without a blueprint.
To illustrate why this is so important, he brings in the cash flow quadrant idea.
Right. And he adapts it for traders. Most people come to the market with an employee mindset. They think, if I put in the hours, I should get paid.
I spent all weekend researching this stock, so I deserve to make a profit.
And the market just laughs at that. The market doesn't care about your effort. It only pays for correct risk management and execution. Some people have a self-employed mindset. The perfectionist. I have to do everything myself. They tend to burn out.
So the goal is to get to the business owner mindset.
That's the holy grail. As a business owner, you don't do all the work. You own a system that does the work for you. Your job is to create, test, and manage the system. You're the CEO of your trading, not a clerk.
And the first document in that business plan is a mission statement. Now, some people might hear that and think it sounds a little corporate and fluffy.
He addresses that. He says it's not fluffy, it's your fuel. You need a powerful why. A reason you're doing this that's bigger than just making money. His example is something like, To produce an infinite wealth stream for my family within 5 years.
Why is that so critical?
Because trading is hard. You are going to have losing streaks. You're going to have periods of doubt. When you're in a painful drawdown, making a lot of money isn't enough to keep you disciplined, but your mission, your deep purpose, that's what will keep you from breaking your rules.
And from the mission, you derive your specific objectives. And he's a stickler for this. Making a lot of money is not an objective.
No, it's a wish. The objective has to be measurable. For instance, my objective is to achieve a 40% average annual return with a maximum drawdown of no more than 15%.
Why does that level of specificity matter so much?
Because the objective dictates the entire design of your system. They're completely linked. If you tell me your goal is 100% returns per year, I know you need a highly aggressive, high-risk strategy. You have to be prepared for massive volatility.
But if your goal is just to make 10% a year and preserve capital, you need a completely different, much more conservative approach.
You can't build the car until you know if you're trying to win the Indy 500 or just drive the kids to school safely. The objectives are the design specs for your trading machine.
This brings us to the actual mechanics of the plan, strategy and risk. And this is where he makes a crucial point about understanding the big picture.
Yeah, you can't just trade in a vacuum. You have to know what kind of market environment you're in. Is inflation a problem? Is the dollar strong or weak? And most importantly, he classifies the market into 6 different types.
Let's run through those. It's about direction and volatility, right?
Exactly. The direction is either bull, which is up, bear, which is down, or sideways, which is flat. And then each of those can be either quiet or volatile.
So you could have a quiet bull market where things just gently drift up, or a volatile bear market, which is just chaos and panic.
Right. And this is why Joe Smith got wiped out. His one and only strategy was buy and hold. That strategy is a genius move in a quiet bull market. It's like printing money. But it is financial suicide in a volatile bear market like 2008.
So you don't need one perfect system.
You need a toolkit, a collection of strategies. You need a plan for what to do when the market is trending up, and a totally different plan for when it's crashing.
Right.
Maybe that plan is to short the market. Maybe it's just to be 100% in cash. But you need the plan before it happens.
Okay, now the part that I think is the real secret sauce of this book. He says it's the most important concept, but the most misunderstood: position sizing.
This is it. This is the concept that once you get it, changes your entire perspective on trading. And he demonstrates it with his famous marble game simulation.
Yeah, this experiment is fantastic. Can you lay it out for us?
Sure. He'll get a room full of people in a workshop. He gives them all a bag of marbles or just a preset sequence of trades. He'll say, okay, the first pull from the bag is a winner, the second's a loser, the third is a loser, the fourth is a big winner. The key is everyone in the room gets the exact same sequence of wins and losses.
So in theory, they should all end up with roughly the same amount of money.
You would think so. But what happens at the end? Some people in the room are completely bankrupt, wiped out, and other people have turned their starting stake into a fortune.
And the trades were identical. How is that even possible?
Because the only thing they could control, the only variable, was how much they chose to risk on each pull of the marble. Position sizing.
So the people who went broke bet too much and hit a string of losers.
They bet the farm and lost. The people who made a fortune bet a small, consistent amount. They survived the losing streak, and when the big winners came, their bets compounded their accounts into the stratosphere.
That's incredible. It literally proves that how much you risk on a trade is more important than what trade you pick.
It is the whole game. Which leads us to his core risk management metric, the concept of R multiples. If you understand R, you understand how professional traders think.
Okay, let's do a deep dive on R. What does it stand for?
R simply stands for your initial risk on a single trade. Let's make it simple. Say you have a $50,000 account and you decide on this trade, based on your stop-loss placement, that you are willing to risk $500. That $500 is your 1R.
Okay, so 1R is my unit of risk. It's the maximum I'm willing to lose on this idea.
Correct. So if the trade goes against you and you get stopped out, you lose exactly 1R, no more. But the magic is on the other side. If the trade works and you end up making a profit of $1,500, how many R did you make?
Well, $1,500 divided by my $500 risk, that's a 3R profit.
Exactly, and this is the key to everything. Tharp's golden rule is simple. Keep your losses small, ideally 1R or less, and let your profits run to be multiples of R. Aim for 3R, 5R, even 10R winners.
And this is how you can be wrong most of the time and still make a lot of money.
Let's do the math. because it feels impossible till you see it. Let's say you make 10 trades. You are a terrible trader. You lose on 7 of them. Your win rate is only 30%.
I'd probably quit. That sounds awful.
But wait, each of those 7 losses is capped at 1R. So your total loss is 7R. Now, your 3 winning trades, you let them run. Let's say they were good trades and you made an average of 5R on each one.
So 3 wins at 5R each is 15R in profit.
Now do the math. You have 15R in profit and 7R in losses. What's your net result?
I'm up 8R. Wow. Even though I was wrong 70% of the time.
If your 1R was $500, you just made $4,000 while being a lousy trader. This is the paradigm shift. Amateurs focus on being right. Professionals focus on making sure their winners are mathematically much bigger than their losers.
So the obsession with finding the perfect entry point is a total waste of time.
It's the least important part of the equation. The money is made in the exits and the position sizing.
But following that math when your account is swinging up and down is incredibly difficult emotionally. This must be where the contingency planning comes in. He talks about what happens to our brains under stress.
Yes, the lizard brain hijack. It's a physiological fact. When you experience intense fear or stress like during a market crash, your body goes into fight or flight mode. Blood literally drains from the prefrontal cortex, the rational thinking part of your brain.
And goes to your muscles so you can run away from the tiger.
Exactly. You literally become dumber at the precise moment you need to be smartest. This is why you cannot rely on your ability to think on your feet in a crisis. You will fail.
He tells the absolutely harrowing story about one of his clients, the one whose girlfriend was in a car crash.
It's a tragic story, but it's such a powerful lesson. This trader's girlfriend is in a terrible accident. He, of course, rushes to the hospital. He's in a state of shock, panic, grief. His mind is a million miles away from the market.
But he had open positions, leveraged ones.
And he had no worst-case contingency plan. He had no, if this happens, I do that protocol. He completely forgot about his trades. By the time he came up for air, maybe days later, his account was destroyed.
Because life happens. The market doesn't care if you have a personal emergency.
It doesn't pause for you. So Tharp's solution is mental rehearsal. You have to sit down when you are calm and rational and imagine every possible disaster.
What if the internet goes out? What if my broker's platform crashes? What if there's a terrorist attack and they halt the market?
All of it. And you write down, step by step, exactly what you will do. If X happens, I will immediately execute plan Y. It's like a fire drill for your finances. When the alarm bell rings, you don't think. You just follow the procedure you already created.
So to wrap this all up, it feels like the path to becoming a super trader isn't about finding some secret on a chart. It's an internal journey.
It really is. It's a 3-legged stool. First, you have to work on yourself, your beliefs, your psychology, taking full responsibility. Second, you have to treat it like a serious business with a written plan, a mission, and clear objectives.
And third, you have to master the mathematics of risk through position sizing and our multiples.
You do those 3 things, and you're already ahead of 95% of the people trying to make money in the markets. The path to consistent profits isn't found on your screen. It's found between your ears.
It's a fascinating and frankly a much more empowering way to look at it. It puts the control back in your hands.
At the end of the day, that's what it's all about. Taking control of yourself to achieve your goals. Trading just happens to be the arena where those lessons are taught with brutal efficiency.
A perfect summary. This has been an incredible deep dive. Thanks so much for walking us through it.
My pleasure. It's a book that can really change how you see things.
Thank you for watching, Barry. Please like us, share, subscribe, follow up in next topic. Come back to continue, Super Trader. It is honestly so great to be back in the studio with you for this. We are tackling a beast today.
We really are. This is where the rubber meets the road.
Absolutely. So, just to reset the room for everyone listening, in our last deep dive into Van Tharp's Super Trader, we spent a lot of time in the messy, complicated, sometimes dark world of the human brain.
Yeah, the psychology.
The psychology, the self-sabotage, and that really uncomfortable truth that you, not the market, not the Fed, not some hedge fund, you are the biggest risk to your own bank account.
Which is absolutely foundational, and I can't stress that enough. You just cannot build a skyscraper on a swamp.
Right.
If your head isn't in the right place, the best trading system in the world won't save you. In fact, a great system will probably just help you lose money faster and, more efficiently if you don't have the discipline to actually follow it.
That is a terrifying thought, a really efficient way to go broke. But today we are pivoting. We're leaving the therapist's couch and we're walking onto the trading floor. We are getting into the nuts and bolts, the meat and potatoes, the actual mechanics of how to trade.
This is the part everyone claims they want. They slog through the psychology chapter just waiting for this. The systems, the numbers, the math, they want the how-to.
But here's the kicker, and I want to start right here because it blew my mind when I read the source material. We are trained by movies, by the news, by everything in our culture to think that being a super trader means you have a crystal ball.
Yeah, that you're an oracle.
You know which stock is going to pop, which crypto is going to the moon. You pick the winners.
Right, the stock picker myth.
Yeah.
The genius who just knows.
Exactly. But Van Tharp says that picking the right stock, what he calls the entry, is actually one of the least important parts of trading.
It sounds like heresy, doesn't it? I mean, especially if you watch any financial news channel for more than 5 minutes.
It sounds insane. If I'm not picking the right stock, what on earth am I doing with my money? I mean, if I buy a stock that goes down, I lose money. So surely picking the one that goes up is the whole point.
You would think so. But
Yeah.
what you're actually doing, or what you should be doing, is managing risk. See, the financial industry, Wall Street, CNBC, all the guys shouting about buy, 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 they have a vested interest in making you think it's all about stock selection.
Oh, okay.
They want you to think they have the secret list of companies that will make you rich.
Yeah.
But Tharp is very, very clear. That is a myth. And it's a dangerous one because it focuses your attention on the one thing you can't control, the future price. And it makes you ignore the things you can control.
So our mission today for this deep dive is to completely dismantle that obsession with entries, when to get in, and replace it with the 3 things Tharp says actually matter.
Exits are multiples and position sizing.
And I'm excited to finally get to the numbers. I feel like I can control numbers. Psychology is slippery, but, numbers are solid.
Careful there. The numbers are solid, yes, but they only work if you have the discipline to follow them. Remember, a system is totally useless if you override it because you have a hunch. But yes, let's get into the math.
Okay, let's tackle this myth of stock selection head on then. Tharp uses a pretty stark example involving the Dow Jones Industrial Average to prove that the whole strategy of buy good companies and hold them forever is basically just gambling.
It is a sobering statistic.
What?
And it's especially sobering for the buy and hold crowd. If you look at the original 30 companies that made up the Dow Jones Industrials, this is way back when the Intel was first created.
Yeah.
And then you fast forward to 2009, which is the time frame he's using in the text. How many of those original 30 do you think were still in the index?
I mean, these are the titans of industry, right? The backbone of the American economy. I'd expect, I don't know, at least half, maybe 10.
One.
One, just one.
General Electric.
That's it.
Every other company was either dropped from the index, went bankrupt, or got absorbed by someone else. And frankly, if you look at GE today, even they have had a massive fall from grace and have been split up.
Wow. So the attrition rate is nearly 100% over a long enough timeline.
Exactly. So this whole idea that you can just pick a good company and hold it forever is statistically, well, it's very unlikely to work. Companies have life cycles, they grow, they mature, and most of them fail.
So if your entire strategy is, I'm going to find the next Amazon and never sell, you are basically betting against history.
You're looking for a needle in a haystack, and the haystack is on fire.
Okay, so picking the company isn't the magic trick. But surely when you buy, it matters. Buy low, sell high. Timing the entry has to count for something.
And that leads me to tell you about the Tom Basso and Van Tharp experiment. This is, in my opinion, one of the single most important studies in trading literature because it just strips away all the ego about being smart.
I love this story. This is the random entry study, right?
Correct. So Tom Basso is a legendary trend follower. He and Tharp were discussing this exact topic, that entry isn't that important. And someone in a workshop challenged them. They essentially said, that's nonsense. If you enter at the wrong time, you're doomed. I bet you couldn't make money with a random entry.
Challenge accepted.
Exactly. So they set up a system. They took 10 different commodities, really volatile markets like gold, oil, corn, and to decide whether to buy or sell, they literally flipped a coin.
Just a coin flip.
A literal coin flip. Heads, you buy. Tails, you sell. It was completely and totally random. No analysis, no charts, no reading the news.
So they are guessing. It's 50-50 at best.
It's worse than that. It's actually harder than 50-50 because they had to pay slippage and commissions on every single trade. In the markets, you start every trade slightly in the hole because of the cost of doing business.
So they were starting with a mathematical disadvantage on every single try.
A huge one. And what happened?
It made money.
The system made money.
How is that mathematically possible? If I go to a casino and I bet red or black on roulette and I have to pay a fee every time I spin, I'm going to go broke. The house edge will just eat me alive. How do they make money?
Because once they were in the trade based on that random coin flip, they didn't act randomly anymore.
Huh?
They use a very specific, very disciplined structure for everything that happened after the entry.
Okay.
They cut their losses quickly. Specifically, they risked 1% and got out if the price moved against them by a factor of 3 times the daily volatility.
Okay, let's slow that down. So if the coin said buy gold and gold immediately tanked.
They got out.
Yeah.
Immediately. Tiny loss. On to the next trade.
But if the coin said buy gold and gold actually started rallying.
They let it ride. They used a trailing stop to lock in the gains. As gold went up, their exit point moved up with it. They squeezed every single ounce of profit out of those lucky trends.
So the magic wasn't the coin flip at all. It was the fact that when they were wrong, they lost a penny, and when they were right, they made $1.
Precisely. They proved, I think, definitively that it's not about the entry. It's all about the exit and the position sizing. You can be wrong 50% of the time. Heck, you can be wrong 60 or 70% of the time and still make a fortune if your exits and your sizing are correct.
Tharp has this great analogy about cars to explain this. He says thinking the setup, the conditions you look for to buy a stock, is the whole trading system is like thinking the key to driving is just unlocking the car door.
It's a perfect analogy. Unlocking the door gets you in the seat. That's your entry. Fine. But unlocking the door doesn't drive the car. It doesn't navigate traffic. It doesn't prevent you from crashing into a wall.
And most traders spend 90% of their time looking for the perfect key to unlock the door, the perfect setup.
And 0 time learning how to steer or use the brakes. It's a total misallocation of effort.
So let's learn how to steer. If entry is just unlocking the door, then Tharp says the steering wheel and the brakes are the exits.
Exits are the key to making money. Period. Full stop. You make money when you sell, not when you buy. And Tharp outlines 4 main purposes for an exit. The crucial thing is, you need to know why you are getting out before you even get in.
Okay, walk us through those 4 purposes.
First, and most importantly, there's the abort exit. This is your initial stop loss. Its only purpose is to produce a loss, but reduce your initial risk. It's you saying, okay, I was wrong, let's protect the capital.
The uncle point. You're tapping out.
Right. It's the point where the pain of being wrong is small enough that you can easily recover from it. Second, you have exits designed to maximize profits. This could be a profit target. If the stock hits $100, I'm taking my money and I'm done.
Okay.
Third, you have exits to keep you from giving back too much profit.
Yeah.
That's your trailing stop. That's what they use in the coin flip study.
Right, that's the letting it ride part.
Exactly. And fourth, which people forget, are psychological exits. This is getting out because you can't sleep at night or you have a big meeting and you just can't watch the screen. And that is a perfectly valid reason for an exit. If your anxiety is too high, you should be flat. You should be in cash.
I want to zoom in on that first one, the initial stop, because Tharp gets into this whole debate about tight stops versus wide stops. And this is where the math starts to get really interesting and kind of counterintuitive.
It's a classic trade-off. A wide stop means you give the stock a lot of room to wiggle around. So let's say you buy at $50. A wide stop might be down at $40. The stock can drop to 41 and then bounce back, and you're still in the trade.
So you don't get stopped out as often. You get to be right more frequently.
You do, which feels good.
Yeah.
Nobody likes being wrong. It hurts the ego. It feels great for the ego, but it's often really bad for the wallet. Because if your stop is that wide, your risk is huge. In that example, you're risking $10 per share. So your reward relative to that risk has to be massive just to have a positive expectancy.
Can we run the numbers on that? Tharp uses a specific example to show the incredible leverage of using tight stops.
Here, let's stick with that $50 stock. You think it's going to go to $60, so that's a $10 potential gain. Now, you have to decide where to put your stop loss.
Okay.
Scenario A. You want to be safe? Play it loose. You put a wide stop at $45. So you are risking $5 to make a potential 10. That's a 2-to-1 reward to risk ratio.
Okay. So if I win, I make double what I risked. Not bad.
Right. Not bad. But now look at scenario B. You use a tight stop. You put it at $49. Now you're risking only $1. If the stock still goes to 60, you've made $10. But you only risked $1. That is a 10-to-1 ratio.
But hang on a second. With a stop at 49, aren't I going to get kicked out of the trade constantly? I mean, a $1 drop is nothing for a $50 stock. Just the regular market noise is going to trigger that stop.
You absolutely will get kicked out. You might get stopped out 3-4 times in a row, losing $1 each time. Bam, bam, bam. You're down $3. But on the fourth try, you catch the move to 60, you made $10. Minus your $3 in losses, you're still up $7.
Wow.
In the wide stop scenario, you held on through the noise, you were right the first time, but you only made $10 while risking $5. The leverage of that tight stop, the multiple, that's where the magic happens. You can afford to be wrong much more often if your winners are massive multiples of your risk.
And this leads us directly into what Tharp calls the magic of R multiples. This was the biggest paradigm shift for me reading this material. It completely changes the language of trading.
It changes everything. It changes the scoreboard. Most people look at their trading account and they just see dollars. Oh, I made $500 today. I lost $200. Tharp says, stop that. Immediately. Dollars are emotional. Dollars are tied to your rent, your car payment, your life. You need to view everything in terms of R.
And R stands for risk.
Your initial risk. In our previous example, if you buy at 50 and put a stop at 49, your R is $1 per share. That is your unit of risk. From now on, everything is measured in R.
Okay.
If the stock goes up to 55, you haven't made $5. You have made 5R. If it drops to 48, you lost 2R, which, by the way, means you completely messed up your exit because you were supposed to be out at 49 at a 1R loss.
Right, so you violated your own rules.
Exactly. But thinking in R allows you to standardize your performance. It doesn't matter if you're trading a $10 stock or a $500 stock. It's all about the multiple of your risk. It completely levels the playing field between different assets.
And this brings up what he calls the 10-bagger fallacy. I hear portfolio managers talk about 10-baggers all the time. Oh, I bought this stock at $10 and it went to $100.
That's the traditional Wall Street definition. A stock increasing in price by 1,000%. That is incredibly rare. It can take years, sometimes decades. It's like hunting for a unicorn. You hear about it because it makes for great headlines.
Right.
But Tharp's definition of a 10-bagger is a trade that yields 10R.
Ah.
And go back to our tight stop example. You bought at $50, stop at 49. Your R is $1. If that stock goes to 60, just a 20% move in price, you have made 10 times your risk. You have a 10R gain.
That is wild. So you can get a 10-bagger result without the stock having to do anything miraculous. It just needs to move a normal amount as long as your risk was tight enough to begin with.
Bingo. You can build a fortune on 2R, 3R, and 5R gains. You don't need the stock to go to the moon. You just need to manage the R. It makes super performance totally accessible within normal market conditions.
This feeds directly into the concept of expectancy. This word gets thrown around a lot in statistics, but simply put, for trading, it's just the average R value of all your trades, right?
Yes, it's the mean R. And this is where people get totally confused between reliability and expectancy.
Yeah, okay, break that down.
Reliability is simply how often am I right? Expectancy is how much do I make on average per trade?
And we tend to obsess over reliability. We want to be right 90% of the time.
Of course, because being wrong feels like pain. It's an ego hit.
Yeah.
But you can have a system that is right 90% of the time. You win a little, win a little.
Yeah.
But if that one loss out of 10 is a disaster, a NAFDR loss because you refuse to sell, your expectancy is negative.
So you'll go broke being right 90% of the time.
Absolutely. This is how many option sellers blow up.
Yeah.
They spend months picking up pennies in front of a steamroller.
And conversely, you can be right only 30% of the times. You lose 1R, lose 1R, lose 1R, but then you hit a 10R winner.
And your expectancy is hugely positive. You are making money while being wrong most of the time. That is the profile of most successful trend followers. They lose often, but they lose small. When they win huge. They don't care about being right. They care about making money.
Okay, so we know we need exits to define our R. We know we want to find these high R multiple trades. But how do we actually build a system that does this? Tharp uses this funny analogy about pants.
Systems, like pants, must fit the individual.
Which is so true. I cannot wear your pants. It would be awkward for everyone involved.
It would be a disaster. But traders do this all the time. They buy a system off the internet or they copy some guru on TV. Oh, Warren Buffett buys value stocks and holds them for 20 years, so I'm going to do that. But does that fit you?
Right.
If you are an impatient person and you need excitement, value investing will drive you insane. You'll sell way too early just out of pure boredom. If you are terrified of losing money, you absolutely cannot trade a trend-following system where you might lose 60% of the time. You will quit just before the big winner comes.
Tharp says you can only trade your beliefs.
That's deep, right? It goes right back to the psychology we talked about last time. If you believe the market is rigged, you will trade like a victim. You'll see conspiracies everywhere. If you believe the market is totally random, you can't trade a system that relies on finding predictable patterns. You have to audit your own beliefs before you even write a single line of code or a single rule.
One of the biggest beliefs Tharp challenges is this idea that one system can work all the time. He introduces this concept of market types.
This is so crucial. The market isn't just the market. It changes its personality. It has moods. Tharp identifies 6 types. You have bull, bear, and sideways. And for each of those, it can be either volatile or quiet.
So a quiet bull, a volatile bear, a sideways quiet market, and so on.
Right. Think about 2017. That was a classic quiet bull. It just drifted up day after day. Very little volatility.
Yeah.
Easy money for buy-the-dip strategies. Then think about 2008 or March of 2020.
Yeah.
That was a volatile bear. Huge swings, limit down days, pure chaos.
And a system designed for a quiet bull market
is suicide in a volatile bear market. In a volatile bear, buying the dip isn't a strategy. It's like trying to catch a falling knife.
So what's the solution then? Do we try and build some kind of super system that can handle everything at once?
No, that's a trap. That's how you get a system that does nothing well. It's a jack of all trades, master of none. Tharp's advice is, don't try to build a Frankenstein system. Build a system that works brilliantly in a quiet bull market. And when the market stops being a quiet bull, stop trading that system.
Just go to cash.
Go to cash.
Yeah.
Or switch to your system that's designed for a volatile bear market. It sounds so simple, but it requires you to actually know what kind of market you're in.
Which requires you to look at the big picture, not just the 5-minute chart you have open.
You have to step back and say, is this environment suitable for my pants? And if the answer is no, you have to change your pants or just stay home.
Okay, so we've covered the myth of entry, the power of exits, our multiples, and system design. Now we arrive at what he calls the Holy Grail. The one topic Tharp says accounts for, 91% of performance variability? Position sizing.
This is the secret sauce. This is what separates the amateur from the professional. And honestly, this is the part where most people tune out because it sounds like accounting.
It totally sounds like accounting. Asset allocation. Snooze. But Tharp cites that Brinson study from 1991. 91% of the difference in returns between professional portfolio managers wasn't their stock picking, it wasn't their market timing, it was asset allocation, it was position sizing.
Let's define it really clearly, because people mix this up all the time. Position sizing is strictly the answer to one question: how much?
How much?
Not what to buy, not when to buy or when to sell, but how many? How many units? How many shares? How much of your money are you putting at risk on this specific idea?
Tharp uses the marble game to illustrate this, and I'd love for you to break this down because it really visualizes why sizing matters more than the system itself.
It's a fantastic analogy. Imagine a black velvet bag filled with marbles. This bag represents your trading system. Now, in Tharp's game, the system is actually pretty good. Let's say there are 50 marbles in the bag. 10 of them are green. These are huge winners. They pay out 10R. Huge.
Okay, big wins.
But 40 of them are red. They're losers, mostly just 1R losses. So overall, this system makes money. It has a positive expectancy. If you just pull marbles out of that bag all day, mathematically, you should end up rich.
So everyone who plays the game should win, right? It's a winning system. The math is on your side.
You would think so. But in the workshop, Tharp gives everyone $100,000 in play money. He pulls a marble from the bag. Let's say the first one is a loser, a red one. Everyone loses. But how much they lose depends entirely on their position size, which they wrote down before he drew the marble.
Ah.
One guy, feeling lucky, might have bet $50,000 on that first trade. He just lost half his account on one marble pull. Another person bet just $1,000. They're fine. They barely even felt it.
And here is the kicker.
Yeah.
Randomness comes in streaks.
Exactly. That is the critical insight. Even with only 40 lunkers in the bag, you can easily pull 5, 6, or even 10 red marbles in a row. That is statistically normal and probable. It will happen.
So if you hit a streak of 5 losing marbles in a row,
the person betting big is bankrupt. They're out of the game before they ever get the chance to draw one of those 10R green marbles. They went broke trading a winning system.
That is the paradox. The system was a winner. The trader went broke.
Correct. The system does not determine your success. Your position sizing determines your success. You have to size your trades small enough so that you can survive the worst case, but statistically normal losing streaks in order to get to the winning streaks. You have to stay at the table.
Tharp introduces the CPR model for position sizing to help us do this. It's an acronym, CPIR.
It stands for cash, position, and risk.
Right.
C is cash. That's your total equity. What do you have in the account right now, this second? P is position size. How many units or shares are you going to buy? And R is risk. What is the risk per unit? Which we already know is the difference between your entry price and your stop loss.
And the formula links them all together. But for the listener who isn't holding a calculator right now, let's just cut to the chase. What is the golden rule here? What does Tharp recommend we actually do to avoid blowing up like the person in the marble game?
The 1% rule?
The 1% rule.
This is the standard for survival in this business. You should never, ever risk more than 1% of your total equity on any single trade.
1%.
Yeah.
That sounds tiny. If I have a $100,000 account, I'm only risking $1,000.
Yes. And let's be crystal clear what risking $1,000 means. This is the most common confusion. It does not mean you only buy $1,000 worth of stock.
Okay, important distinction.
It means that if the trade goes wrong and hits your stop loss, the loss to your account is only $1,000.
Can we walk through the math of that? I want to make sure this point really lands for everyone.
Sure. Let's use that $100,000 account. Your max allowed risk is $1,000. That's your 1%. You want to buy that stock at $50. You do your analysis and decide your stop loss should be at $45.
Okay.
So your risk per share is $5. 50 minus 45. To find out how many shares to buy your position size, you take your total allowed risk, $1,000, and you divide it by your risk per share, $5.
1,000 divided by 5 is 200.
So you buy 200 shares.
Okay, 200 shares at $50 each. That's a $10,000 investment.
Correct. You are investing $10,000 of your cash. That's 10% of your account. But you are only risking $1,000, which is 1% of your account. Because if it drops to 45, you sell and the loss is contained. See the difference?
I do, and that distinction is critical. You can have a large position but maintain a small risk if your stop is tight enough.
Precisely. And by limiting your risk to just 1%, you could be wrong 10, 15, even 20 times in a row, and you are still in the game. Your account will be bruised. You might be down 20%, but you aren't broken. If you risk 10% per trade, a bad week wipes you out completely.
And once you have these rules in place, your exits, your R multiples, your position sizing, you can stop guessing and you can start simulating.
Right.
Tharp seems to really hate the word prediction.
He despises it. Prediction is an ego trap. I think Apple will go to 200. You don't know that. Nobody knows that. The market is far too complex. Simulation is different. Simulation says, I don't know what the market will do next, but I know that my system, over time, generates these kinds of R multiples.
So you take your history.
You take your history. Okay, on average, I get 3 1R losses, and then I get 1 5R win. And you simulate that pattern over 1,000 future trades.
It's like running a stress test on your own system.
That's exactly what it is. It tells you the probability of reaching your financial goals or the probability of hitting a maximum drawdown that makes you want to quit.
Yeah.
It takes the emotion out of it. You stop trying to be a guru and you start acting like a casino owner. The casino doesn't predict the next hand of blackjack.
Right. They don't care.
They don't care if you win the next hand. They just know that the math is in their favor over 1,000 hands, 1,000,000 hands. They play the probabilities.
There is a psychological trap that Tharp mentions here called the "it didn't work" mentality, and I feel like I've fallen into this a million times. You try a new system, you lose 3 times in a row, you say this system is garbage, and you stop using it.
And usually, you stop using it right before the winning streak was about to start.
Every time.
That losing streak is statistically normal. If you had simulated your system, you would know, oh, my system usually has a streak of 4 losses in a row about once a month. So when it happens, you don't panic. You say, here's the monthly losing streak. It's right on schedule. I just have to stick to the plan.
But without the simulation.
Without simulation, you interpret normal variance as failure. And that's a recipe for disaster.
That is such a powerful reframe. Normal variance versus failure. So we've covered a ton of ground. Tharp summarizes all of this into 6 keys to a great system. I want to rapid fire these just to lock them in for the listener.
Let's do it. Key number 1, reliability. How often do you win? And surprisingly, Tharp says this is the least important factor.
Okay, least important. What's number 2?
Key 2, relative size of profits. That's your reward to risk ratio. This is very important. Can your system hit those 5R or 10R winners?
Number 3.
Key 3, cost. Commissions and slippage. They eat your profits silently. You have to keep them as low as possible.
Number 4.
Frequency. How often do you get an opportunity to trade? If you have a winning edge, you want to be able to apply it as often as possible. The law of large numbers is your best friend.
Okay, 2 more. Key 5.
Size of capital. Do you have enough money to trade properly and handle the inevitable swings? If you're undercapitalized, you'll make bad emotional decisions out of desperation.
And the big one, number 6.
And key 6, position sizing, the most critical factor of all, the how much.
It's funny, looking at that list, almost everyone focuses all their energy on key number 1, reliability. I want a system that wins 90% of the time. And almost nobody focuses on key number 6, position sizing.
Which is exactly why 90% of traders fail. They are optimizing the wrong variable. They are trying to be right instead of trying to make money. The two are not the same thing.
Okay, so let's try and unpack this. Putting it all together, we started this journey with the psychology in part 1. Now we have the mechanics. The big takeaway for me is that I need to stop looking for the magic stock.
Stop looking for the magic stock. Stop watching the news for tips. Stop asking your Uber driver what crypto to buy. Start looking at yourself. Define your own beliefs. Then pick a system that fits those beliefs, whether it's trend following, band trading, value investing, whatever. Then define your exits to calculate your R. And finally, use position sizing, that 1% rule, to ensure you survive long enough for the math of your system to actually work in your favor.
It's like Tharp says, the Holy Grail isn't some secret indicator. It's not a black box you buy online for $99.
The Holy Grail is an internal shift. It's the deep understanding that you don't trade the markets. You trade your beliefs about the markets. It's a mathematical equation combining a system that fits you with the discipline to size your positions correctly. It's not magic, it's method.
Here's the thought to leave you with, something to chew on. If you walked into a casino and you realized you could set your own betting limits, you could change your bet size after you'd already seen the cards, and you could decide exactly when to walk away from the table. Would you still play the game like a gambler, hoping for luck? Or would you start to play it like the house? Because Tharp is basically handing you the blueprint to be the house.
But being the house requires discipline. It's boring, it can be repetitive, but it's profitable. The question is, can you handle the boredom of being rich, or do you need the excitement of gambling?
That is the question. We are going to leave it right there for today. This has been a deep dive into the mechanics of becoming a super trader.
It's always a pleasure to crunch the numbers.
Thank you for watching. Please like, share, subscribe, follow up in next part.
Come back to continue Super Trader. It feels like we've been on quite a journey with Van Tharp already.
It really does.
We spent so much time in our previous discussions breaking down the absolute mechanics of trading systems. You know, we've talked entries, exits, position sizing.
The real nuts and bolts of the machine.
Exactly, the nuts and bolts. But today, we're shifting gears, pretty significantly. We are moving into part 5 of Super Trader. This is the section called More Ideas for Producing Optimal Trading Performance. And honestly, looking at the material, this feels like where the rubber really meets the road.
It really is. You know, to use a car analogy, you can build a Ferrari of a trading system, something that, backtests beautifully, has incredible profit potential.
Looks great on paper.
Looks great on paper, but if the driver doesn't know how to shift gears or panics every time there's a curve in the road, that Ferrari isn't going to win any races.
It might even crash.
It might crash. And part 5 is all about the driver. It's about the, let's call it, advanced optimization of the human operator.
Which is so interesting because I think most people hear optimization in trading and they immediately think about tweaking the engine.
Right.
Changing a moving average from a 50 to a 200 or finding a better indicator. But Tharp is saying the real edge comes from the psychological and structural glues that hold the whole trading business together. We're talking about avoiding self-sabotage and ditching the whole prediction game.
That's the key phrase right there, like a business. Tharp makes a very strong distinction here. This isn't about finding a lucky lottery ticket.
No.
It's about bridging that gap between having a theoretical system and actually executing it with the efficiency of a CEO.
Okay, so let's get into the mind of that CEO. One of the first things Tharp hits us with is this concept of keep it simple.
Yes.
And I have to say that feels so counterintuitive. You see professional trading desks in movies, and it's 12 screens, 3 news feeds.
Blinking lights everywhere. It looks incredibly complex.
It does. And that image probably sells a lot of expensive hardware. But Tharp leans on some really fascinating psychological data here.
He does. He points out that our conscious mind has a very, very hard limit. It can only process about 7 chunks of information at a time.
7 chunks. That seems incredibly low.
±2. So maybe 9 on a good day?
I feel like I'm processing more than that just driving to the store.
You might feel like you are, but you're probably toggling between them. And here's the kicker. That 7 chunk limit is under normal, calm conditions.
Ah.
When you add the stress of having money on the line, when your heart rate goes up because a trade is moving against you, that capacity drops. It drops fast.
You literally get dumber under pressure.
You are biologically setting yourself up to fail if your system is too complex. Tharp uses this really telling example from his consulting work. He profiled a broker trader who was, well, he was ranking in the bottom 1% of all investors.
Bottom 1%. I mean, you almost have to try to be that bad.
It was a complete disaster. And, your first thought is this guy just didn't understand the market right.
Sure, he needed more knowledge.
But that wasn't it. It was an abundance of chaos. His desk was a mess. His organization was non-existent. He's listening to clients with conflicting goals.
So his external world was just a mirror of his internal state.
Exactly. The insight Tharp has here is, I think, profound. He says, chaos in the mind leads to chaos in life. If your brain is cluttered, your P&L is going to look cluttered with losses.
So to fix it, you don't add more, you simplify.
You simplify, you strip it down so it fits within that limited mental capacity.
That makes perfect sense. Keep it simple so you don't short circuit. Now, this whole conversation about what actually works leads us right into probably the most misunderstood term in all of finance.
Oh, yes. The Holy Grail.
The Holy Grail. Right.
Yeah.
And usually when I hear that term, people are talking about some magical indicator,
One that's never wrong.
the thing that gives you a green arrow and the price just skyrockets, a prediction tool.
That is the common myth, yeah. Everyone's looking for the crystal ball. But Tharp just flips this on its head. He says the Holy Grail isn't an external tool at all. It's an internal state, and surprisingly, a mathematical ratio.
Okay, you can't just drop mathematical ratio and walk away. How on earth can a Holy Grail be a math equation?
He defines the quality of a trading system with a specific formula. It's your expectancy, divided by the standard deviation of your R multiples.
All right, let's pump the brakes. We need to unpack that. Expectancy, we know from our other deep dives, is basically what you expect to make on average per dollar you risk.
Correct. Over many trades, yeah. If it's positive, you're making money over time.
And R multiples is just your unit of risk. Risk $100, that's 1 R. Make 200, that's a 2R win.
Exactly. So the denominator in that formula, the standard deviation, that measures the volatility of those R results.
The bumpiness of the ride.
The bumpiness of the ride. A system can make money, but if your results are these wild swings, a huge win, 5 losses, another huge win, a big drawdown, that's a high standard deviation.
An emotional roller coaster. You're rich on Tuesday and feeling broke by Friday?
It is. And a system like that is incredibly hard to trade because it's emotionally exhausting. You'll quit. A Holy Grail system, Tharp says, is one where the profits are consistent and the variation is low.
A smooth equity curve.
That's what you want. He even gives us specific numbers. He says a ratio of about 0.20 to 0.24 is, average. It's a decent system.
Okay.
But a ratio of 0.70 or better, that, he says, is Holy Grail level.
0.7. So why is that the Grail? Is it just because it feels better to have a smooth ride?
No, it's not just about feelings. This is where the business logic comes in. A system with a high score is a Holy Grail because the low variation makes it incredibly easy to use aggressive position sizing. If you know the ride won't be that bumpy, you can confidently increase your bet size without that constant fear of ruin, that confidence, that internal state allowing you to scale up. That's the real Grail.
It's not that the system predicts the future. It's that the system behaves so consistently that you don't have to panic. It lets the operator step on the gas.
Precisely. It turns trading into a scalable business instead of a terrifying gamble.
Okay, so let's say we have that system. We've simplified it. We have a great ratio. The next question is, how do we actually get rich? How do we go from a hobby to a serious enterprise?
This is a critical transition. Most people think the only way to make more money is to just blindly bet more.
Or find that one stock that goes up 1,000%.
Right. But Tharp outlines 4 very specific, very business-like ways to grow. And he notes that capital, funnily enough, usually isn't the problem. The problem is finding the best use for it.
Okay, so what are the 4 growth methods?
First one is pretty straightforward. Develop new systems. If you have a system for a bull market, build another one for a sideways market.
So you're diversifying your strategies, not just your stocks.
Exactly. So one system can pick up the slack when another is having a down month. Second is find more markets. If your system works great on the S&P 500, don't just stop there.
Test it on the NASDAQ, on gold, on oil.
On international indexes, whatever. He gives an example where a trader could go from making 10R a month to 100R just by applying the same logic to 10 different markets.
That's just working smarter, not harder.
The third one is ad traders. This is more for funds, obviously, but a single person has a limit. Tharp suggests maybe $50 million effective capacity before your psychology starts to crack.
Right.
So to manage $500 million, you need more people.
Makes sense for the institutions. But this fourth one, this one feels like it applies to everyone.
Yes, and it's my favorite because it costs $0 to implement. Improve trader efficiency.
Efficiency sounds a little bit like corporate jargon. What does he actually mean by that?
It's just brutal math. Let's say your system on paper should generate a 40% return if you follow it perfectly. But you're human. You enter late, you get scared and exit early, you forget a stop loss, and let's say those little mistakes cost you 20% of your potential return.
So your system could have made 40%, but your bank account only shows a 20% gain.
Exactly. You're operating at 50% efficiency. Now, most people would go try to find a system that makes 80%. They blame the car.
When they should be looking at the driver.
Yes. Tharp says if you can just coach yourself to reduce those mistakes down to, say, only 5%, you've massively increased your bottom line without changing a single thing about your strategy.
That is huge.
Yeah.
It's like in sports, the team that wins is often the one that makes the fewest unforced errors.
It's a perfect analogy, and I think the biggest unforced error, the biggest way people fumble the ball, is this next topic. Avoid making predictions in the market.
Oh, the obsession with prediction. It is the original sin of trading, isn't it?
It really is. It's everywhere.
You turn on financial news, and it's a parade of experts saying, where is Apple going next week? Is the recession starting on Tuesday?
And Tharp has a real problem with this because prediction usually comes from ego. It's a psychological need to feel certain in a world that is fundamentally uncertain.
We want to feel like we know what's coming.
We do. And he actually surveyed top traders, people who are consistently profitable, and he asked them for their market predictions.
And I bet they had some incredible secret insights.
They essentially shrugged. One of them said, I don't predict the market. Another said something like, these are just scenarios. The market is going to do what the market is going to do.
That is almost frustrating to hear. If they're not predicting, what on earth are they doing? How do you make money if you don't know where the price is going?
They're not predicting, they are reacting.
Reacting, okay.
Tharp lists 5 ingredients for this. First, they just follow the signals from their system. If it says buy, they buy. They don't ask, will it go up? They just ask, is this a valid signal?
They surrender their opinion to the rules.
Correct. Second, and this is so crucial, they get out immediately when the market proves them wrong. They don't hold on, hoping their prediction will eventually come true.
Right. A predictor holds on because they want to be vindicated. A reactor just cuts the loss.
Exactly. No ego. Third, they let profits run. Fourth, they rely on the law of large numbers. They need enough trades for the math to work. And the fifth ingredient...
Let me guess. Position sizing.
Position sizing. They manage their bet size so they can survive the inevitable losses. It's about staying in the game, not being a psychic.
It's funny because I don't predict. It sounds like I don't know what I'm doing to a novice. But to an expert, it means I'm prepared for anything.
That's it. If you predict the market will go up and it goes down, you freeze. You're confused. If you just have a plan for both scenarios, you're never confused.
So if we aren't predicting, we're following rules. And that brings us to the dark side of trading. Mistakes and self-sabotage. I want to get really specific here. How does Van Tharp define a mistake?
This is one of the most rigorous definitions in the book. A mistake is, very simply, not following your written trading rules.
That's it.
That's it. But think about the implication. If you don't have written trading rules...
Everything you do is a mistake.
Technically, yes. Or you can't even define a mistake because there's no baseline. Every decision is just random or emotional.
That is a tough pill to swallow. So if I get a hot tip, buy the stock and it doubles, I made money. Was that a mistake?
According to Tharp, absolutely. A massive mistake. You got lucky, but you reinforced a terrible habit. You rewarded yourself for gambling.
And eventually that habit will destroy you.
It will. On the flip side, if you follow your rules perfectly and lose money on a trade...
That was not a mistake.
Correct. That was just a business expense. Good trading is about the process, not the outcome of any single trade.
He shares a pretty terrifying case study about the cost of mistakes, doesn't he?
He does. It really stuck with me. A futures trader running a huge $200 million account.
A serious profession.
Yeah. A total pro. Tharp's team analyzed his performance and found that over 9 months, he made 11 specific mistakes.
11 mistakes in 9 months. Honestly, that sounds amazing. I probably make 11 mistakes before my first coffee.
It sounds low, right? But look at the cost. Those 11 mistakes cost him 46.5 R.
Whoa! 46.5 R. So 46 times his initial risk on a trade.
Yes. If he was risking 1% of that account per trade, he basically threw away a 46.5% potential profit just on execution errors. His final profit was likely half of what it could have been.
That is staggering. It really drives home that the Holy Grail isn't a better entry signal. It's just doing what you said you were going to do.
The money is in the discipline.
Yeah.
The market offers the opportunity. Your discipline is what captures it.
So the big question, how do we prevent this? How do we stop repeating mistakes? We're human. We get emotional. We get distracted.
He offers some preventative medicine, and it starts before the market even opens. He calls it the daily mental rehearsal.
Like something an athlete would do, visualizing the race.
Very similar. At the start of the day, you have to ask yourself, what could go wrong today that might cause me to make a mistake?
You're preempting the chaos.
You're visualizing the failure points so they don't surprise you. Tharp tells this heartbreaking story about a day trader, great trader. One day he gets a call that his girlfriend has been in a severe car accident.
Oh, wow.
So naturally, he panics, rushes to the hospital, but in the shock of it all, he forgot he had open positions. And he didn't use hard stops because he always watched the screen.
He wasn't mentally rehearsed for a life interruption.
Exactly. And the market doesn't care about your personal tragedy. It kept moving against him. If he'd rehearsed, what if there's an emergency? His rule might have been close all positions immediately, but he hadn't.
That's a heavy example, but it really proves the point. You have to prepare for the things you think won't happen.
And then when the day is done, you have to close the loop with what he calls the daily debriefing.
What's the question we ask ourselves there?
It's simple. Did I make any mistakes?
And again, the definition is, did I follow my rules?
Right. If the answer is no, even if you lost a ton of money that day, you pat yourself on the back. You did your job. You were a good employee of your own business.
That is such a hard mental shift to make. Losing money can equal a good job.
It's the only way to survive. And if the answer is, yes, I made a mistake, then you have to do the work. You analyze why. Were you tired, stressed? You have to identify the trigger so it doesn't happen again.
Continuous improvement ties in for your trading brain.
Precisely. And this ties back to the beginning. Simplicity. Did I follow my rules? Yes or no. It's that simple.
So what this all means for you listening is that we need to stop looking for a magic indicator. We need to stop trying to predict the market.
We need to be efficient operators.
And that leads to the final point. You cannot ignore the fundamentals.
But be careful with that word, fundamentals. In Tharp's world, the fundamental isn't a company's PE ratio.
What's the true fundamental then?
The true fundamental is you. It's your psychology, your adherence to the plan, your risk management. If you ignore the fundamental of your own mind, the best system in the world won't save you.
So the Holy Grail was in the mirror the whole time.
Indeed.
We have covered a lot of ground. We talked about keeping it simple, that 7-chunk limit of the brain. We redefined the Holy Grail as a volatility ratio.
We looked at scaling through efficiency, avoiding prediction, and the massive cost of mistakes. And that daily mental rehearsal, that's probably the highest ROI activity you can do.
Absolutely. So here's our challenge to you. For the next week, try the daily debriefing. At the end of each day, ask yourself, did I follow my rules? Be honest. And if you don't have rules to follow, well, your first job is to write them down.
Master yourself. And the market becomes a much friendlier place.
Couldn't have said it better myself. That wraps up our deep dive into the advanced optimization strategies of SuperTrader. Thank you for watching. Please like, share, subscribe, follow up in next video.